Hi guys, I'm Adam, and today I'll be talking about the intuition behind the balance sheet. So there are several categories within the balance sheet. First is assets, second is liabilities, and the third one is shareholders fund or shareholders equity. So I will dive straight into these three sections. So let's look at the first section. Fixed assets are usually on the long-term investments made by the firm to purchase a land or equipment or vehicles that is supposed to last longer than 12 months. So these are usually factors of production involved in producing the goods and services: premise, equipment, and vehicle. So the second category of assets is actually current assets, meaning that those assets will actually be converted into cash in less than 12 months. For instance, let's look at stock. Stock is basically the goods that is piled up in the warehouse in case there is an uptick in demand. For instance, during the Black Friday week, the demand for goods and services may soar instantly, so they'll probably use this stock to meet the demand. And after the consumer pay for the goods and services that you hold in stock, the stock will be turned into cash. And second is debtors. It's kind of pretty confusing if you first look at the term debtors. You don't necessarily know whether it belongs to current assets or it belongs to current liabilities. But it actually belongs to current assets. It has another name which is more intuitive, is account receivable, meaning that that's a cash you're supposed to receive in the near future. So let's break down this term a little bit to help you know exactly why that belongs to current assets. So when we actually think about debt, so we can think a debtor as a guy chasing the debt. So that way you probably remember debtor better. And also I can give you an example of what debtors are in the real business world. For instance, let's say that I own a firm and I have a supplier. So the supplier have already supplied the goods and services to me, but I didn't pay the cash immediately to the supplier. So at this moment, on the balance sheet of the supplier, the money that I own the suppliers will actually be counted towards the debtor category for the supplier in the supplier's balance sheet. And the third term of the current assets is actually cash at bank. This is much more intuitive because cash is basically cash. So let's move on to the current liability, which is creditors. Creditors has another name just as debtors. Creditors has another name which is account payable, meaning that that's the amount of money you need to pay in the near future. So when we think about credit, we usually think about banks. So you will need credit in order for you to borrow from the banks. So if we are at a business standpoint, we can't think about creditors as borrowing money from the bank, because for most firms, their relationship with banks was basically borrowing money from the bank. So you can think about that way so that it will be categorized as a current liability. And now moving on to this category, which is net working capital. Net working capital is calculated by the current asset minus the current liability. It's 4 minus 6 in this case, which give us -2. Net working capital is basically the amount of cash that you have after paying all your liabilities in the short term. It's basically the flexibility of the firm to deal with the current situation, like the buffer stock. Like what if there is a certain emergency situation happening to a company? So if you have positive net working capital, you probably can deal with it easily. But if you have a negative net working capital, that might be problematic for your business. And here is another term called net asset employed. Net asset employed is basically, as over here, is the fixed asset plus the net working capital. Gives us 8. So it's quite unintuitive that IB actually put the long-term liability column down here. But as you can see, as I have outlined it here, IB put the equation of net assets employed equals to shareholders' equity plus long-term liabilities. So that's basically the same as a formula we usually see, which is this formula: total assets minus total liabilities equals shareholders' equity. That is the most common formula outlined in most business management books. So it's actually the same. As you can see, if I move the long-term liability terms up, or in this case, I move this term to the left side of this equation, it gives us net assets employed minus long-term liabilities gives us shareholder equity. And as you can see, that net assets employed is actually fixed asset plus current assets and minus current liability. So it's basically total assets minus total liability, and it's shareholders' equity. So these two equations are basically the same. It really depends on how they arrange it. So you can either put the long-term liabilities down here, or you can put it up there. But IB loves to put it down here, maybe just to confuse things a little bit. Or I really don't know why they do that. So that's pretty much it. So yes, I would like to talk a little bit more about the shareholders' funds, which contains the share capital and reserves. Reserves are basically retained profits. So this amount of profit earned after like paying the shareholders and stuff, they can keep these profits as the money they will need for future investments or other purposes. And long-term liability is pretty self-explanatory. It's the bank loan, the long-term bank loan that you own the bank. And that's basically this. And finally, I will move on to a real-life example, because you may have noticed that the real-life balance sheet is more complicated. So I will show you a really condensed version of the balance sheet. So basically, the categories are the same: assets, liabilities, and also shareholders' equity. So notice here, there's another column called marketable securities over here. What marketable securities actually means is it consists both of government bonds and also the stock of other companies. For instance, in here, Apple might hold stock of many other companies. So in this case, it will be counted as marketable securities. Or it may hold some sort of U.S. government treasury bonds, or like other sort of government bonds, which is pretty stable, and it could be converted into cash easily. So think about the like the stock you have in the stock market. You can just sell it at any time. So it's basically like a cash for the firm. So it's current assets. And long-term marketable assets is basically the same. As it's like long-term government bonds or similar things. And also, we can see that there is another column called intangible assets. So that is not covered in the balance sheet of the IB curriculum, because many companies won't include this intangible assets. The reason for the firm to include intangible assets is usually because that like Apple has acquired a lot of firms. So during acquisition, Apple may pay a premium, that is the price over the listed shareholder's equity when Apple actually purchased that company, because Apple believes in the brand value of that company, that the company is worth more than its listed shareholders' equity. So that portion will actually be included as goodwill. So that's this value over here. And intangible assets basically means like the brand value of Apple and how people will buy Apple just because of its brand and things. These are actually estimates. So it's like you don't know exactly how much it's worth, but Apple will give us an estimate of how much it will worth. So, and basically everything else is basically the same. So that's basically it, and hope you guys enjoy it. Thank you very much.